Hello, friends. Welcome to this special episode. In these special episodes, we try to have a data centric approach in how our behavior impacts our investing. And this is another such video in that series. So, as this chart is showing you, there is a long uptrend, and then the market starts to come down. And the question in everybody's mind is, how deep is this fall going to be? Is the market crashing? Should I get out? I mean, is this a very short-term opportunity to add money? Should I, liquidate my entire portfolio and probably I'll get it much cheaper later on? There's a lot of uncertainty as soon as there is a blip in the chart like this, and we will discuss on with a basis on past data as to what has happened in the market, how people have reacted to it, how it has recovered, and so on and so forth. But this is perennially the first question that comes to most people's mind is how to maybe sidestep the market when it is falling. Uh, Usually that is not a good policy, but we will discuss it. So the question recently also after Nifty touched 25,000 is, will there be a 10% correction in the market now? So let's first get a comparison between what is a short-term market correction and what is a bear market, right? So a decline of about, let's say, 10% from the recent peak can be defined as a normal, regular, expectable market correction. At any point of time, a 10% fall is something that you should expect that it can happen anytime without reason. To not expect even a 10% fall is living in some storyland where everything is perfect and nothing wrong ever happens. 10% is like the minimum that you should expect. In fact, in my own, if I share you my thought process, if I have 100 rupees worth of portfolio, I always think that I have 80. 20% is something that I am willing to just not get worried about. Beyond 20 is where the real correction starts for me. So in this particular definition that we're showing you here, up to around 10% is market correction. 20% or more will be termed as a bear market. If the market corrects more than 20%. Usually these smaller corrections, 0 to 20, last for only for few months. Market corrects, it returns back. The longer term trends remain strong. Bear markets, the trends change and it could last for several months or even years, which we have not seen recently. So a lot of folks have forgotten what is a bear market, but the market will remind you of it sooner or later. The causes for a market correction could be, just as simple as the buyers exhaustion of buying. This also happens sometimes that market goes up daily, 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 up, 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 and even the buyers are exhausted. The market is not falling. I mean, I'm not getting opportunities to churn. I'm not getting opportunities to book. So a lot of times buyers strike happens where there's no further demand, and the market corrects on its own weight. There are always fringe on the fence sellers who at the very first dip of the market will just throw away their portfolio, and it could be triggered by some small data point by, let's say, a central bank or by the government, or some larger important companies results, or some political talk somewhere. So those are minor sort of things that will prick the sort of froth that is accumulating a little bit. Bear markets are typically caused by more severe economic downtrends. So there's complete, gradually as the market comes down, there's complete lack of demand from buyers. There's loss of confidence. The projections by companies, by the government, by the central banks are all poor for next 1 year, 2 years. It looks extremely bleak. Those are the scenarios. Maybe a drought is coming, or maybe interest rates are continuously going up, inflation is not in control. All those cause, macro factors cause a bear market. Impact, of course, is for all of these, market correction or a bear market will be losses to investors. For market correction, it is usually temporary. So you get a decline, but then market picks up. 3 months later, 2 months later, you are back at your previous peak. Bear markets are much more severe. They can cause very severe losses to investors and may take years to recover. For instance, if we see the case of, let's say, 2008 peak and the bear market that started post that, the GFC and then the Lehman crisis, it took a couple of years for Nifty to come back to where it was. And for portfolios which were, you know, invested into, let's say, real estate infrastructure at that point of time, it took almost a decade for those to come back. So significant losses are possible in bear markets. Now there is another nuance to it, to the corrections, that it could be a time correction or it could be a price correction. So a time correction happens when, prices don't fall really with, I mean, heavily, minor falls, but prolonged stagnation. We've seen this, for instance, in Nifty post October 21. There was a year and a half of just stagnating prices within about 10 odd percent from the top. That is time correction. Market is buying time while earnings are catching up. So that it is more palatable for new demand to come in and liquidity to flow to the market. Price corrections are, as the name mentioned, just the correction in price. I mean, it could happen very suddenly. A result comes out, the market was expecting something else, a company delivers extremely poor result, suddenly there is a price correction, and then maybe the next phase will start. The price movements are within time correction, no significant change in prices, just range bound, gradually maybe coming down as well is the usual trend. Price corrections, of course, are sharp, very down phase. And even in time corrections, I can give you examples of, let's say, very big names, Hindustan Lever, Reliance, ITC, where for years together, and currently we are seeing this in, let's say, HDFC Bank, we are seeing this in possibly Asian Paints. Many names, many prominent names are there where there's not much of downward movement of price, but there is a stagnation of price. And that stagnation is basically a time correction. So market is waiting, spending time in that range while gradually by natural growth of the company, the earnings are catching. Durations are long for time corrections, can last for months or years. Price corrections are usually sharp, weeks or days, and it will just correct, and then all the you can say venom is out of the system, and then you start again. Causes for time correction may be lack of growth, excessive price appreciation, market consolidation, just some things getting very expensive, yet those companies are really good. So for instance, a company which has fantastic market share, fantastic brands, everything is good, but just that the growth is maybe single digit growth is happening now, large base, but the price is 80 times earnings. So investors don't want to sell it also, but there's no fresh money coming in also, so it'll just keep doing a sideways correction for a long period of time. Price correction are usually shift in investor sentiment, so change in economic factors, change in results, change in outlook, change in some sectoral policy by the government, some geopolitical event, all that impacts price correction. Investor behavior for both requires a lot of patience, but for time correction, your thesis should be that you have a very long term view on that stock regardless of the price or the time that is getting spent. You are so confident about that company, maybe because of its product, its management, or your own just confidence on that company, that you have to buy and wait out that time. uh, Price corrections may require very active trading strategies or rebalancing strategies, just like I mentioned earlier. 2008 crisis, real estate stocks and infrastructure stocks were there in most portfolios. When it crashed in 2008, those were the stocks that didn't come back. You had to rebalance, you had to reshift your sectoral preferences after the fall to make sure that your portfolio comes back. Nifty came back because Nifty will continuously getting changed. Nifty is an actively managed strategy. If you see it from that point of view, every 6 months there is a bunch of people who will sit and say, okay, we will remove this stock, we will bring this stock in, and the aim is to get Nifty back to a new high. So let's now look at all the data points for 10% plus falls in the last 20 years. The idea here is to uh, learn about the history of the last 20 years, which many of you maybe not be aware of if you have not lived through that. and we try to learn from the history. What happened in the past, how markets recovered, how much time did it take, how deep did they go. There is no prediction here. See, let me be honest here, that we cannot predict anything, that markets will do this or will do that. But what we can do is that we can look at history, and we can try to you know absorb some learnings from there. So this is the entire history that I'm going to show you today, about approximately uh, 27 odd years, maybe, or maybe 24 years actually, starting from 2000. Uh, we've had all these events, starting in 2005, then 2007, one in 2008, then 2010, 2015, three in 2018, then in 2020, then October 21, where market have fallen 10% or more. Very interesting to see is that we've had no 10% or more fall since October 21. We are going to be near a 3-year anniversary of this very, very soon. So the first fall that we are covering here came in 2005. We were in the emerging markets bull run, and even in bull runs, you can have deep corrections. So this is where a 10%, 12% fall actually came through. Uh, it took 27 sessions to come down, but it took 74 sessions, 74 days for full recovery, which is not bad. 74 days is just less than 3 months. So this is where it recovered, and then it just continued on its onward journey. Another one came in October 2005. You had a sharp 13% correction here. The recovery was quite fast within a little more than a month, and the fall was also quite sharp at 11 days. So 13% fall in October, November 2005. Then you had another one in May 2006. So can you see that very quickly in 2005 we had two instances, and 2000, that rally from out of the previous fall went from 2500 to almost 3700. So almost a 50% gain in the market before a huge crack once again. And this was a global synchronized fall in most markets. So only in 6 sessions we fell more than 10%, and ultimately the market fell almost 29.8% in this fall. And it took a good 4 or 5 months for this entire fall to get recovered. So very, very, very sharp fall, but a very gradual recovery. Then you had another one in 2007, and market in this bull run was getting matured. You had a 15% fall in just 14 days, and then a month and a half or 2 months and a half for recovery back to the new high. Then you had another one in 2007, July, September. Again, you had a 11.8% fall, 40 days to recover, 17 days to fall, but then a fantastic recovery and follow of almost a 50% gain in the market in the next 5 months. So those are the kind of super normal uh, next legs that we get. So one thing that we need to always think about is that whenever you fall and you fall less, you are able to pick up and do the next leap much farther. But whenever you fall deep and fall far down, the ability to bounce or to go back up is tremendously reduced. And then you had the big fall from January 2008, where in 9 sessions you fell down 10%, and then you kept falling, and 59.8% was the close to close. 59.8% was the drawdown, although on an intraday basis you went down much further, I think 65 or 70%. And then it took a very sweet time to recover completely, almost 695 days, although it did come close here, but it took a long time for that recovery to happen. And then 2010 till 2013, almost 3 years was taken in this particular fall, where the fall again was 28%, and it took 765 sessions to go back up and make a new high. So you can see that in that decade of 2004, 2005 to 2013, 14, you had so many instances of very deep falls, 20%, 30%, 60%. Of course, eventually everything came back. That is one takeaway that you need to see. And some were, shorter time corrections, and others were longer price corrections. Uh, and some were just mild corrections, some were bear markets. So the next one came in 2015 to 2017, where you also had the demonetization at the end, uh, and in any case, the markets was slowing down even before demonetization. So you had a 22% fall in a matter of just a year or more, and then it took almost a couple of years for a full recovery to happen, a year and a half actually, for a full recovery to happen. And you can see that from the bottom here near 7,000, the next sort of peak went straight to almost 12,000. So big bounces from these bottoms. Then you had the 2018 very sharp correction, and this was, didn't last too long. It was only 10%. Uh, the the trigger here was a regulatory shift in how mutual funds can hold small caps or mid caps in particular categories, and there was a lot of shift within categories, and that caused a significant damage in the several parts of the market. And here also you can see just a 10% fall, but it took almost 4 months for this to recover. And once it recovered, it didn't go too far, and there was another correction post that. So August 2018-19, there was a much deeper fall here, and you had a 14.5% fall, which took almost a long period for a recovery. 156 days, almost a 7 or 8 month period was spent in this recovery. So you can see in most cases falls are very sharp, recoveries are slow. I mean, if you see through all the charts, falls are like, you're coming in a uh, elevator down, and then you're taking the stairs up, and that is usually the trend for most falls. Uh, then you had the June 19 to November 19 crack of 10%, and then it cracked further till March of 2020. And you had sorry, this is the 11% fall that we had pre-COVID, where you had this dip, and it was recovered quickly within 118 days. But the fact here is that this was sort of a wave-like formation that was happening. So 4 or 5 weeks of fall, and then recovery in the next few months. This was like a very lethargic market at that top, and it was waiting for some crack to happen, which COVID provided that eventually. And then COVID fall was, of course, 15 January 2020, and you could only recover from it in November 2020. But this fall, I think if you see the last 20 years, the 2008 fall and the COVID fall are the sort of the iconic falls in the market, where the falls were deep, 60% or so in the first one, 38% in this one, and both had very good recoveries. Even the 2008 one, almost by 2008 end, you had the bottommost part, and by 2010, you were back almost there. So, two of the deepest drawdowns that we've had in the last few decades have taken just about a year to come back up. I mean, and if you have lived through any of these two falls, it seemed like the end of the world. That these markets will never come back, and just within 1 year, those markets have come back, and people who were able to allocate during those recoveries really made extremely superb returns from the market. So you need to cut out a lot of emotions from the investing, because all this happens because most people have emotions in the market, that, oh, something will go wrong, companies will not be able to perform, hence we should sell, right? And sometimes it may also happen in certain cases. And of course, COVID was one case where nobody was uh, able to foresee that within a year or two, things may come back to near normal once again. And then post that, we've had a time correction. Now, this is a very beautiful example of a time correction where you had a 17% fall, yet it was sort of buying time the entire year and a half, that almost 2 years in fact, where the market remained stagnant, went for a dip, came back, remained stagnant, was in a range, took 274 days to recover, and then went on to the new sort of recovery phase. So average, if we see the number of market days that it takes to reach the 10% fall, it used to be very, very sharp earlier, where you had 27 days, sometimes even 6 days. But of late, you can see in the last decade that number is now much higher. So it's a very clear distinction that from 2000 to 2008, you can say markets used to very rapidly fall, and now the falls, even in COVID, for instance, are much more slow to go to a 10% fall. Uh, the uh, uh, the fact remains that we've not had any fall of 10% or more since October 21. I hope we don't. But I mean, if you see the frequency, uh, every few years we do get one. So not expecting that market will not fall 10% in the near future or in future is a bit maybe not so practical. uh, Maximum drawdown in each of these 10% falls. So, given these two aberrations, I would say, where the world seemed like collapsing in COVID as well as in the GFC, most other times you had, somewhere near 20%, 15 to 25% kind of average. Max drawdown average is 22%, is where the turn is very likely to happen on that. So my sense, like a lot of people keep asking also, that what is that drawdown where one should aggressively add. So one point is of course near 10%. So if you are near 10% fall, there is a good probability that the long term trend is on and we are just doing a short term correction. And then around 20-25% is that sweet spot where most likely than not, you would get a good sort of bottom there. And then the third category is a disaster category, where it could go to 40, 50, 60%, which is very difficult to sustain, to see that, and to buy there. So these are sort of some history lessons that we can draw from there. Now about the recovery. The average recovery period for all 10% falls is about 244 days. So if you convert 244 trading days to calendar years, it is about 1 year of trading. There are between 230 to 240 trading sessions in a year. So about 1 year is what it may take if we get a 10% or more fall. But of course, there are always exceptions to that. There could be very fast recovery. For instance, in October 2005, just 34 days. Um, so averages probably don't do justice to that. But in your mind, you should be prepared that if the market falls, and if it falls 10% plus, I'm in for at least about a year. If I get out early in terms of recovery, I'll be lucky. Otherwise, I'm mentally tuned for a year of patience, or maybe 2 years of patience. So what happens usually is that when your expectations are not met, only then your behavior changes. If you are already building in those buffers in your expectation, you will not get easily frustrated. Just like I gave you the example that up to a 100 rupee portfolio, if it goes to 80, I'm not flustered about it, because in my mind that number is 80 today itself. So think of worst case scenarios also. So I do that also. That what happens tomorrow if my portfolio goes down 50%? Will will my life change? Will heavens fall? Will I not sleep? What will happen? So you need to come to that mental framework, and proper allocation within your. So this is where asset allocation also becomes very important. That I know that because I'm allocated to other asset classes that will counter equity movement. So I'm not afraid if markets, let's say, were to go down 50%, because I know I'll be saved to some extent. So these are the kind of frameworks that you need to build in your mind. If you don't expect the market to fall and the market falls, then you will be really troubled very, very badly. So change your perspective about market corrections, and just sort of be in that, you can say, be in that mode of expectations where it is likely that the market will always positively surprise you. So if I'm thinking of a 20% and the market comes down by 10% and goes back up, I'm positively surprised. See, I was ready for 20, but the market, recovered in 10% only. So corrections are important, of course. The corrections will continue to happen. It's an opportunity for the market to remove weak hands, to remove the excesses, uh, and to essentially bring more balance back to the market. It is also an opportunity for you to become better than the average investor. So at the end of the day, this is some sort of a competitive race that we are running, where somebody has to really lose for others to make money, and you need to be above average to really make money from the market. It is of course a great opportunity for rupee cost averaging. So market comes down, you can see it as an opportunity that my money can buy more stocks. Uh, so why sort of regret that once it does happen? And the market puts up a brilliant performance after every correction. So that we've shown, after every deep correction, the performance is really brilliant. So better to embrace the corrections rather than fear one. Better to become a better investor. Better to become a better uh, investor with reasonable expectation. Your expectation of returns also from the market should be reasonable. Allow the market to beat your expectation. That is where you will really sort of enjoy that. I was expecting 15, market gave me 20. Brilliant. I was expecting 20, market gave me 40. So those are the kind of things that should continue to surprise you, positively, and that gives you that positive energy towards the markets and the portfolio. So I hope you like this content. Do send us your comments. I'm always looking forward to reading your comments. I try to respond to each one of them, and this is fun for me. I hope it is fun for you as well. Do share these videos. Do share our channel with your friends and family. That will be great if we are able to get more subscribers to the channel. It gives us more motivation to do this. The team really works hard, and they are thrilled if more and more people join the channel. Thank you so much. Bye bye.